stop scrolling and look at this red line. That is not a stock market crash. That is not a crypto dip. That is the sound of the world's second largest economy pulling the plug on the United States. Right now, while the mainstream media is distracted by inflation numbers and political drama, Beijing has quietly dumped $680 billion of US Treasuries. It is the lowest level in 18 years. Ask yourself, if China's economy is supposedly collapsing and they need cash to survive, why aren't they hoarding dollars? Because they aren't. They are selling American debt and buying 74 million ounces of physical gold. You don't make a trade like that to fix an economy. You make a trade like that when you are preparing to survive a total financial freeze. This isn't portfolio rebalancing. This is the financial equivalent of digging a trench before the artillery starts firing. The war hasn't started on the news yet, but on the balance sheets, it's already here. Welcome to the breakdown. Let us look closely at the crime scene. In the sterile, air-conditioned offices of the US Treasury Department, a report is generated every month called the Treasury International Capital System, or TIC data. To 99% of the population, this is a boring spreadsheet filled with government accounting noise. But to the 1% who understand the plumbing of the global financial system, the report released last month was not just data, it was a siren. The numbers on line 14 do not scream, they whisper. And right now they are whispering that the largest creditor to the United States government is leaving the building. We are looking at a figure that should terrify anyone holding a 30-year mortgage or a retirement account heavily weighted in equities. $680 billion. That is the current holding of US Treasury securities by the People's Republic of China. To put that into perspective, it is the lowest level since 2009. We have broken through the psychological floor of $700 billion, and the trajectory is not leveling off. It is accelerating downward. The slope of this chart does not suggest a gentle diversification of assets. It suggests an evacuation. When you look at the monthly sell-off volume, it mirrors the frantic exit of a hedge fund during a margin call. Yet this is being executed by a sovereign nation with the second largest economy on the planet. The mainstream financial press, the outlets you see on cable news every morning, have a very convenient explanation for this. They tell you that China is in economic trouble. They say the property market in Shanghai is imploding. The youth unemployment rate is skyrocketing, and local governments are drowning in debt. Therefore, the logic goes, Beijing is selling these US bonds to raise cash. They need dollars to defend the yuan and bail out their crumbling developers. It sounds plausible. It fits the comfortable narrative that the West is strong and the East is collapsing. It wraps the anomaly in a neat little package that allows Wall Street to sleep at night. But there is a fatal flaw in that logic. In fact, it is not just a flaw. It is a mathematical impossibility based on the data we have from the other side of the ledger. If you are a nation in crisis, desperate for liquidity to save your dying economy, you prioritize cash. You sell your long-term assets to get US dollars because dollars are the oxygen of global trade. You need immediate spending power to plug holes in your banking system. What you do not do, under any circumstances, is take that desperate cash and dump it into an asset that is historically illiquid, cumbersome to transport, and yields absolutely zero interest. Yet that is exactly what the data shows Beijing is doing. This is where the narrative fractures. While the Treasury data shows an exodus from American debt, customs data from Switzerland and Hong Kong shows a voracious, unprecedented appetite for physical gold. The People's Bank of China has reported gold accumulation for 18 consecutive months, adding over 10 million ounces to their official reserves. And that is just what they are telling us. The unofficial numbers, the gold moving through the Shanghai Gold Exchange, which does not show up on the central bank's balance sheet, suggests the real number is closer to 74 million ounces. Let's pause and apply critical thinking to this specific maneuver. You do not buy 74 million ounces of physical metal to bail out a property developer in Shenzhen. You cannot pay a construction crew with gold bars. You cannot intervene in the foreign exchange market to prop up your currency using metal sitting in a vault. Buying gold is the opposite of seeking liquidity. It is removing capital from the velocity of money and locking it in a cage. If you are comfortable with the explanations given by the talking heads who read teleprompters for a living, this investigation is probably not for you. There are plenty of channels that will tell you everything is fine, and the market will go up forever. But if you are tired of being the last person to know why your portfolio just dropped 20%, and if you demand the raw, unfiltered logic that governs the real decisions of global superpowers, then you are in the right place. We are building a dossier here that the algorithms usually suppress, so make sure you have joined us so you do not miss the next file. Back to the paradox. If this is not an economic rescue mission, what is it? When you sell the world's most liquid asset, which is the US Treasury bond, and exchange it for the world's most distinct hard asset, which is gold, you are not engaging in economics. You are engaging in logistics. You are moving from a system based on trust to a system based on possession. A US Treasury bond is a promise. It is a promise that the United States government will pay you back in the future. It relies on the SWIFT system. It relies on the Federal Reserve. And most importantly, it relies on the geopolitical goodwill of Washington. Gold requires no goodwill. It has no counterparty risk. It cannot be frozen by a click of a mouse in New York or Brussels. This leads us to the terrifying question that nobody in Washington wants to answer out loud. What if the sell-off of $680 billion has nothing to do with the Chinese economy? What if it is a defensive fortification? When you look at the speed of the dumping, it matches the timeline of a nation preparing to be disconnected from the global financial grid. They are actively removing their wealth from the jurisdiction of Western sanctions. They are effectively saying that they anticipate a scenario where their access to dollars will be cut off completely. There is only one scenario where the United States freezes the assets of its largest trading partner. That scenario is war. We are watching a financial pre-deployment. The tanks have not started their engines, and the missiles are still in their silos. But the capital is already retreating to the bunkers. But to understand exactly how this mechanic works, and to confirm if this theory holds water, we cannot just look at China today. We have to look at the only other time in modern history this exact pattern appeared on the charts. The blueprints for this financial fortress were not drawn up in Beijing. They were drawn up 4 years ago, 4,000 miles to the west, by a woman the West underestimated until it was too late. To understand the silent panic currently unfolding in the banking halls of Beijing, we have to leave China completely. We have to travel 4,000 miles west and travel back in time to an office in Moscow in the year 2014. This is where the blueprint for the current crisis was drawn. It was not drawn by a general or a spy, but by a woman in a gray suit named Elvira Nabiullina. She is the governor of the Central Bank of Russia, and perhaps the most competent technocrat the West has ever faced. In 2014, after the annexation of Crimea, the West slapped sanctions on Russia. The ruble collapsed. The Russian economy was bleeding. Most central bankers would have panicked. But Nabiullina did something that seemed insane at the time. She stopped trying to defend the currency with dollars. Instead, she started a systematic, ruthless purge of American debt from the Russian balance sheet. She began selling US treasuries and buying gold. She moved state assets into euros and yuan. The Western financial press mocked her. They called it paranoia. They called it the Fortress Russia strategy and dismissed it as the frantic maneuvering of a rogue state. The editorial boards of the Financial Times and the Wall Street Journal assured their readers that the global financial system was too integrated for Russia to truly decouple. They said that gold was an archaic relic and that the US dollar was the only true safe haven in a storm. They were wrong. Nabiulina wasn't paranoid. She was simply the only person in the room who was reading the terms of service of the global financial system correctly. She understood that in a digital banking system, you do not own your money. You only own the right to access it, and that right can be revoked by the system administrator. Fast forward to February 26th, 2022. This is the most important date in modern financial history, more significant than the collapse of Lehman Brothers. This was the day the G7 nations decided to freeze the foreign exchange reserves of the Central Bank of Russia. In a single weekend, $300 billion of sovereign wealth, money that Russia had earned by selling oil and gas over 2 decades, was effectively deleted from the ledger. It was a display of shock and awe financial warfare that was supposed to cripple the Kremlin. But in Beijing, the reaction was not celebration. It was absolute horror. The Politburo was not looking at the tanks rolling toward Kyiv. They were looking at that frozen bank account. For decades, the Chinese Communist Party had operated under the assumption that while they might have political disagreements with the West, the US Treasury bond was sacrosanct. They believed that the sanctity of private property and sovereign debt was the bedrock of American capitalism. February 26th shattered that illusion. It proved that the US Treasury bond was not a risk-free asset. It was a political asset. It proved that if you cross a certain geopolitical red line, your national savings account goes to zero. This is the Moscow mirror. Beijing is looking into the glass and seeing their own future. They realize that if they make a move on Taiwan, the $3 trillion they hold in foreign reserves will not be a war chest. It will be a hostage. The instant a blockade of Taiwan begins, the West will press the same button they pressed on Russia. The difference is that China has 10 times more to lose. So now, overlay the charts. Take the liquidation pattern of Russia from 2014 to 2018 and place it directly on top of China's activity from 2022 to today. The correlation is terrifying. It is the exact same algorithm. The only difference is the velocity. China is moving faster. They are dumping agency debt. They are dumping equities. They are dumping long-dated treasuries. And just like Elvira Nabiulina, they are moving that capital into physical gold and strategic commodities. They are buying copper, iron ore, and grain. Things you can touch. Things you can store within your own borders. Things that cannot be frozen by a swift sanction order from Brussels. But here is the detail that the amateur analysts miss. They look at the market right now and say that China is making a mistake because they are selling at a loss. Interest rates in America are high, which means the price of old bonds is low. By selling now, Beijing is crystallizing billions of dollars in losses. The pundits ask why a rational economic actor would sell an asset when it is trading at a discount. The answer is that they are not a rational economic actor anymore. They are a rational survivalist actor. If you are in a burning building, you do not wait for the fire sale to end before you leave. You leave immediately, regardless of the cost. China is accepting a 20% loss on their bond portfolio today because they are calculating a 100% loss in the future. They are paying an insurance premium. They are essentially laundering their own money, taking it out of the clean, digital Western system and moving it into the dirty, opaque world of physical assets and shadow accounts. This acceleration we are seeing, this drop to $680 billion, is not a market signal. It is a pre-war signal. It tells us that Beijing believes the window of opportunity is closing. They are clearing the decks. They are removing the leverage that Washington holds over them. Every $1 billion of debt they sell is one less diplomatic lever the US State Department can pull. They are insulating their economy from the inevitable shockwave of sanctions. However, selling $600 billion of bonds without crashing the market instantly requires a magician's touch. You cannot just dump it all on the open market. You need a place to hide the transaction. You need a proxy. And this is where the investigation takes a dark turn into the plumbing of the European financial system. Because while the official numbers say China is selling, another set of numbers in a tiny country in Europe is acting very strangely. To understand where the money is really going, we have to look at an anomaly that has appeared in the accounts of a custodial bank in Belgium. To see the ghost in the machine, we have to look at a small, unassuming country in Western Europe that has suddenly become a financial superpower overnight, Belgium. If you look at the official TIC data from the US Treasury, it shows a strange anomaly. Every time China sells a massive block of US debt, the holdings of US debt in Belgium mysteriously spike. This is not because the Belgian people have suddenly developed an insatiable appetite for American Treasury bonds. It is because Belgium is the home of Euroclear, one of the world's largest clearinghouses. In the world of sovereign finance, Euroclear acts like a digital mask. When the People's Bank of China buys or sells bonds directly, their name appears on the ledger. It is a public signal. But when they route those transactions through a custodial account at Euroclear, the buyer is listed simply as Belgium. This is the Belgium Shuffle. It is the exact same tactic the Kremlin used in the lead-up to 2014 to hide their divestment from the West. We are seeing a mirrored reflection of that strategy today. China is moving its US treasuries into these custodial accounts not to keep them, but to launder the sale. They are breaking large block orders into smaller, anonymous chunks to avoid triggering a panic in the bond market. They are exiting the building through the back door, wearing a disguise, hoping that Wall Street doesn't notice the room is getting empty until it is too late. The rise in Belgium's holdings does not offset the drop in China's holdings. It merely softens the visual impact of the crash. It is a delay tactic, a smokescreen designed to buy time while they finalize the real transition. And the real transition is not happening in the bond market. It is happening in the physical bullion market. This brings us to the most damning piece of technical evidence in this entire investigation: the spread between the gold price in London and the gold price in Shanghai. In a healthy, efficient global market, the price of gold should be roughly the same everywhere, minus the cost of shipping. But for the last 18 months, the Shanghai Gold Exchange has been trading at a massive premium compared to London and New York. At times, this premium has spiked to over $100 per ounce. Why would a rational Chinese bank pay $100 more for an ounce of gold in Shanghai than they could pay for a paper contract in London? The answer lies in the lesson they learned from the Moscow Mirror. A paper contract in London, known as an ETF, or unallocated gold, is just a promise. It is a digital entry on a server that says you own gold. But that server is subject to Western jurisdiction. If sanctions hit, that gold disappears. It gets frozen just like Russia's $300 billion. The premium in Shanghai tells us that Chinese buyers do not want promises. They do not want paper. They are paying a fear tax to get immediate physical delivery of the metal. They are draining the vaults of the West. We are witnessing a slow-motion bank run on the COMEX and the LBMA. The metal is leaving London and New York. It is being melted down into 1-kilogram bars, and it is disappearing into vaults in Beijing and Shenzhen. This is not investment. This is the behavior of someone who believes the banking system is about to close its doors. They are trading counterparty risk for physical security, and they are willing to pay any price to do it. Let's pause here for a second, because I need to know if I am the only one seeing this pattern, or if this is obvious to you as well. The mainstream narrative, the one you hear from CNBC and the White House economists, is that this is just normal diversification. They say China is just rebalancing its portfolio like any prudent investor. But when I look at this data, when I see them paying massive premiums for physical delivery and using shell accounts in Belgium to hide their exit, I don't see diversification. I see an evacuation. I see a superpower packing its bags in the middle of the night. So I want you to be the judge. Go down to the comments right now and tell me. Do you think this is just innocent financial housekeeping? Or are we looking at the prep work for a divorce? Type diversification if you trust the official story, or evacuation if you think they are running for the exits. I need to know if I am reading too much into these charts, or if we are all seeing the same smoke. Now, let's look at where the rest of the money is going, because $680 billion does not just vanish into thin air. If you look at the official foreign exchange reserves of China, the number seems stable, hovering around $3 trillion. This stability is designed to calm the markets. But if you look deeper into the balance sheets of the state-owned commercial banks, the shadow reserves, you see a very different picture. China operates a unique system where the central bank, the PBOC, can instruct state-run commercial banks to act on its behalf. These banks are now holding hundreds of billions of dollars in assets that technically belong to the state, but do not appear on the central bank's official report. This is dark matter finance. They are moving the dollars off the official books and into these shadow entities. Why? Because sovereign assets can be sanctioned easily. Commercial bank assets are much harder to track and much harder to freeze legally. They are dispersing the target. Instead of having one giant pot of gold that the US Treasury can target, they are spreading their wealth across thousands of smaller, commercial accounts globally. It is a shell game designed to make the sanctions weapon ineffective. This technical deep dive confirms that the mechanism for a financial decoupling is already built. The pipes are laid. The gold is in the vault. The bonds are being sold. The assets are being hidden. The how is no longer a mystery. The technical data proves that the gun is loaded and the safety is off. But knowing how they are doing it is only half the story. To understand when they will pull the trigger, we have to look up from the spreadsheets and look at the map. We have to connect this financial evacuation to the geopolitical timeline, because there is only one event big enough to justify this level of economic self-mutilation. The technical anomalies we uncovered in the Belgian custodial accounts and the Shanghai gold premiums are not just accounting tricks. They are the logistical footprints of a geopolitical strategy that has been refined over a decade. If you take the graph of China's accelerating bond sell-off and overlay it with the timeline of military exercises in the Taiwan Strait, the correlation ceases to be a coincidence and becomes a countdown. We are witnessing the synchronization of a balance sheet with a battle plan. President Xi Jinping has been explicitly clear in his recent internal speeches, telling his generals to prepare for worst-case scenarios and high winds and choppy waters. In the language of the Chinese Communist Party, these are not metaphors for a recession. They are code for a total rupture with the West. The rate at which Beijing is liquidating its US Treasuries suggests they have a specific target date in mind. At the current velocity of $680 billion being offloaded or hidden, their exposure to the US dollar will reach a strategic minimum within the next 18 to 24 months. This creates a terrifying window of vulnerability. It implies that once the financial shield is fully constructed, once the gold is in the vaults and the bonds are gone, the kinetic phase of the conflict can begin. We saw this exact sequence with the Moscow Mirror. Putin spent years building a financial fortress before a single tank crossed the border. Beijing is simply building a bigger fortress for a bigger war. But there is a darker layer to this strategy, a nuclear option that goes beyond just defensive preparation. The $680 billion remaining in China's hands is not just an asset. It is a loaded gun pointed directly at the heart of the American financial system. In a normal market, buyers and sellers meet to find a price. But if China decides to weaponize this debt, they don't need to find a price. They just need to flood the market. Imagine a scenario where, in retaliation for a US naval maneuver or a new trade tariff, Beijing orders the immediate dumping of their remaining Treasury portfolio, not over months, but over days. The result would be a catastrophic spike in US Treasury yields. The bond market operates on supply and demand. If the largest foreign owner dumps supply while the Federal Reserve is already struggling with inflation, there are no buyers left to absorb the shock. Yields on the 10-year Treasury note would rip higher, smashing through 5%, 6%, potentially touching 8% in a matter of weeks. You might think this is just a problem for Wall Street traders, but this is where the geopolitical web entangles your living room. The 10-year Treasury yield is the benchmark for the 30-year fixed mortgage rate. They move in lockstep. If China pulls the trigger on that bond dump, the mortgage rate in America does not just go up, it effectively closes the door on the American dream. We are talking about mortgage rates hitting 10 or 12% overnight. The US housing market, which is already frozen because nobody can afford to move, would shatter. Property values would plummet because the monthly payment for a standard home would double. The equity you think you have in your house would evaporate. This is the leverage Beijing holds. They know that the US economy is an asset bubble economy, built on the foundation of cheap debt and high real estate prices. By holding the pin to that bubble, they possess a deterrent more powerful than an aircraft carrier. They are holding the net worth of the American middle class hostage. And this brings us to the collateral damage. In this clash of superpowers, where Washington weaponizes the dollar and Beijing weaponizes the debt, the grass that gets trampled is your retirement account and your purchasing power. We have lived for 30 years in a deflationary paradise, subsidized by cheap Chinese labor and cheap Chinese goods. That era is dead. The decoupling we are tracking means that the cheap toaster, the cheap iPhone, and the cheap sneakers at Walmart are relics of the past. As China pulls its money out of the West, they are also pulling their manufacturing capacity into their own sphere of influence, prioritizing trade with the BRICS nations over the US consumer. This leads to a structural shift in inflation that the Federal Reserve cannot fix with interest rates. When the supply chain breaks because of a geopolitical divorce, prices go up, and they stay up. Your 401k, which is likely a mix of stocks and bonds, is designed for a world where the US and China are partners. It is not hedged for a world where they are adversaries. If the bond market crashes because of a Chinese dump, the safe part of your portfolio collapses. If the stock market crashes because of a supply chain rupture, the growth part of your portfolio collapses. There is no hiding place in a traditional 60-40 portfolio when the two largest economies on Earth stop talking and start fighting. The web is complete. The technical signals from the gold market, the hidden accounts in Belgium, and the open threats regarding Taiwan are all converging on a single point in the near future. The system is blinking red. We are not looking at a distant theoretical risk. We are looking at a train that has already left the station and is accelerating. The only question remaining is not if the collision will happen, but who will be left standing when the dust settles. The data suggests that the old rules of money are about to be rewritten by the victors, and the timeline for you to adapt is shorter than you think. Everything we have analyzed so far points to one inevitable, radical conclusion that most people are too afraid to voice. If you zoom out from the daily noise of stock tickers and political scandals, If you look down at the world map as if it were a chessboard, the chaos suddenly resolves into a terrifyingly clear picture. What we have witnessed over the last 30 minutes is not a series of random economic events. It is the coordinated movement of pieces in the opening phase of a grandmaster-level endgame. The $680 billion of sold treasuries are not just numbers on a spreadsheet. They are the pawns being withdrawn from the center of the board. The 74 million ounces of gold being moved into vaults in Beijing are not investment assets. They are the rooks, the heavy castles being moved into position to fortify the king. When a player sacrifices liquidity for security, when they trade speed for armor, it means only one thing. They are no longer playing for profit. They are playing for survival. We are looking at the logistics of a black swan event that the elite in Beijing have not only predicted, but are actively manufacturing. For decades, the global order was maintained by a simple contract. The United States provided the security and the currency, and China provided the cheap labor and the goods. That contract has been torn up. The frantic activity we see in the Belgium custodial accounts and the Shanghai Gold Exchange is the sound of the world's second-largest economy unplugging itself from the life support system of the US dollar. They are accepting the short-term pain of selling at a loss to achieve the long-term strategic goal of total sovereignty. They are clearing the table because they know the table is about to be overturned. The greatest danger right now is the trap of Western hubris. Policymakers in Washington and Brussels are operating under the fatal assumption that the sanctions weapon is invincible. They look at what they did to Russia in 2022, freezing $300 billion overnight, and they believe they hold a checkmate button. They think that the threat of financial annihilation is enough to deter China from moving on Taiwan. But the data we have analyzed today proves that Beijing has already neutralized this weapon. You cannot freeze what is not there. You cannot sanction a gold bar sitting in a vault in Shenzhen. By systematically draining their exposure to Western finance, China is rendering the US sanctions regime obsolete before the conflict even begins. And here lies the most chilling realization of this entire investigation. History teaches us a brutal lesson about the relationship between economic power and military force. When economic weapons become useless, military weapons start speaking. If the United States loses the ability to hurt China financially because China has successfully built this gold fortress, then the only remaining option to maintain global dominance is kinetic force. The decoupling of these two economies removes the final guardrail preventing World War III. When nations stop trading, they start fighting. We are watching the removal of the mutual destruction pact that kept the peace for 40 years. On this global chessboard, you and I are not the players. We are not even the pieces. We are the statistics, the collateral damage. The governments managing this transition are not concerned with your mortgage rate, your retirement plan, or your cost of living. They are concerned with winning a zero-sum game for the next century of hegemony. The inflation that will result from this rupture, the destruction of the purchasing power of the dollar, and the potential collapse of the bond market are considered acceptable losses in their war rooms. They have their bunkers. They have their gold. The question is, do you? Most people will continue to sleepwalk through this, trusting the comforting lies from the television until the day the ATM stops working or the currency resets. But you have chosen to watch this until the end, which means you suspect that the storm is coming. Suspecting is good, but preparing is better. We are building a network of people who refuse to be blindsided by the headlines. If you want to understand the next